Hello! Welcome to Capital Sensei. Today, we're going to dive deep into a book that's often considered the next level after Rich Dad, Poor Dad. We're breaking down Robert Kiyosaki's Rich Dad's Guide to Investing. We'll explore his controversial 90-10 rule, the different levels of investors from the absolute beginner to the ultimate capitalist, and the critical framework he calls the BI triangle, which is basically a blueprint for building a successful business. This is about transforming your mindset from someone who works for money to someone who makes money work for them. And as always, whenever we can, we answer questions left in the comments. So if you have a question about a concept, or if you want to share your own journey with investing or business, please drop a comment below. Your stories and insights help everyone in this community learn and grow together. Let's start with the central idea that frames the entire book, the 90-10 rule. Kiyosaki states that 10% of the population controls 90% of the wealth. Now, you might hear that and think it's just an unfair fact of life. But Kiyosaki presents it as a choice. His guide is about learning the rules that the 10% play by, so you can gain them. It's not about luck or inheritance. It's about education and mindset. Think of it like a huge potluck dinner. Most people bring a small dish and get a small plate of food. But a few people understood the assignment differently. They organized the entire event, and as a result, they control the whole buffet. The book is your invitation to learn how to be an organizer, not just a guest. Before you can even think about where to put your money, Kiyosaki hammers home one point above all others. Investing is a mental game first, a financial one second. Your greatest asset isn't a stock or a piece of real estate. It's your mind. If your mind is trained to think like an employee, valuing job security and a steady paycheck above all, you'll struggle to become a successful investor. The poor dad mindset seeks to avoid risk at all costs. The rich dad mindset, on the other hand, understands how to manage risk and use it to its advantage. It's a fundamental shift from seeking security to seeking freedom. So, how do you know where you stand? Kiyosaki breaks down the world of investors into different categories, and being honest about which one you fall into is the first step. The first level, which he calls level 0, is the financially challenged. These are people who have nothing to invest because their expenses equal or exceed their income. They are in debt and have no financial plan. It's a stressful and difficult place to be, but recognizing it is the only way to start planning your way out. It's the financial equivalent of being lost in the woods without a compass. The first task is to simply acknowledge that you're lost. Next up is level 1. The savers are losers. This might sound harsh, but there's a crucial economic principle behind it. These are people who diligently put money into a savings account, thinking they're being responsible. The problem? Inflation. Your money in the bank is like an ice cube on a warm day. It's constantly melting away, losing its purchasing power. In an era where interest rates on savings are often lower than the rate of inflation, you are, in real terms, losing money every single day. Being a saver is better than being in debt, but it's a strategy for not losing fast, not a strategy for winning. Then we have level 2, the too busy investors. These are often successful professionals, doctors, lawyers, executives who are smart and make a good income. But they believe they're too busy to learn about investing. So they hand their money over to a financial planner or a stockbroker and hope for the best. Kiyosaki warns that this is incredibly risky. You are outsourcing the most important part of your financial life. It's like hiring a world-class personal trainer but never learning about nutrition or proper exercise form yourself. You're completely dependent on them, and you have no idea if they're actually doing a good job. Level 3 is where things get really dangerous. These are the "I'm too smart" investors, but a better name for them would be the gamblers. These are the amateurs who think they can outsmart the market. They don't have a solid plan. They chase hot tips, jump on speculative bandwagons like meme stocks without any research, and look for that one big score that will make them rich overnight. They often confuse luck with skill. Winning a few times reinforces their belief that they're a genius, but over the long run, without a real strategy, they almost always get wiped out. It's the financial equivalent of trying to win the lottery. Now we start getting into the territory of the 10%. Level 4 is the professional investor. These are people who take their financial education seriously. They understand their own financial habits. They have long-term goals, and they invest with a clear strategy. Kiyosaki points out that professional investors invest in their education before they invest their money. They read books, attend seminars, and build a network of advisors. They don't just throw money at things. They do their homework, analyze deals, and understand the fundamentals of what they're buying. They are pilots, not passengers. Within this professional category, Kiyosaki makes a fascinating distinction based on the old-school grading system. He talks about A, B, and C students. The A students were the ones who did well in school and often become the highly paid employees who fall into the too busy category. The B students, he says, are the technical investors. They are the analysts, the number crunchers. They can read a financial statement like a novel and are brilliant at picking stocks and analyzing market trends. They are essential to the financial world. But who does Rich Dad say is the most likely to become ultra-wealthy? The C student. Why? Because the C student didn't thrive in the rigid structure of school. They learned to get by, to be resourceful, and most importantly, they learned to hire the A students to work for them and the B students to advise them. The C student's strength isn't in technical analysis. It's in building a team and a system. They are the entrepreneurs. They don't look for an investment to buy. They create the investment. This leads directly to the ultimate level. The final stage, level 5, is the capitalist. This is the pinnacle of the Rich Dad philosophy. A capitalist doesn't just buy assets. They create assets from scratch. They build the businesses that the professional investors invest in. Think of someone like Elon Musk or Jeff Bezos. They didn't just buy shares in a car company or an online bookstore, they built them. They create jobs, products, and investment opportunities for everyone else. They are playing the game at the highest possible level because they essentially designed the game board itself. Their goal is to build self-sustaining systems that generate massive wealth. To get to that capitalist level, or even just to be a solid professional investor who builds a business, Kiyosaki provides a powerful framework he calls the B-I triangle. That's B for business and I for investor. This is the anatomy of a successful business, and understanding it is crucial. Imagine you're trying to build a house. You can't just start nailing boards together. You need a blueprint. The BI triangle is that blueprint. At the very top of the triangle, its guiding point is the mission. This is the why behind the business. It's more than just making money. A powerful mission is almost spiritual. It's the core belief that drives the entire enterprise. For a company like Apple, the mission was about empowering individuals through technology. A strong mission attracts passionate employees and loyal customers. Without a clear and compelling mission, a business is just a hollow shell, destined to crumble under pressure. Supporting the mission are two crucial elements: the team and leadership. The team is the who. Rich Dad's philosophy is clear. You do not have to be the smartest person in the room. In fact, you shouldn't be. A successful entrepreneur surrounds themselves with people who are smarter than them in specific areas. A brilliant accountant, a sharp lawyer, a creative marketing director. It's like building a championship sports team. The coach doesn't have to be the best player at every position, but they need to be the best at assembling and managing the talent. And that's where leadership comes in. Leadership is the how. It's the ability to take that team of talented individuals and get them to work together towards the common mission. A great leader inspires, motivates, and directs the energy of the team. They create a culture where people can do their best work. Without strong leadership, even the most talented team will devolve into chaos, with everyone pulling in different directions. Now we get to the core mechanics of the triangle. The next layer is cash flow management. This is the lifeblood of any business. You could have the greatest product and the most inspiring mission in the world, but if you run out of cash, the game is over. This is where basic financial literacy becomes non-negotiable. You have to understand the difference between profit and cash flow. You need to be able to read a simple income statement and a balance sheet. It's like being a pilot. You absolutely must know how to read your fuel gauge and understand your rate of consumption. Working hand in hand with cash flow is communication. This is the voice of your business, both internally to your team and externally to the market. External communication is things like marketing, branding, and sales. How do you tell the world about your product? How do you convince customers to buy it? Internal communication is about keeping your team aligned and informed. A business with poor communication is like a body where the brain can't talk to the hands. Nothing gets done effectively. Below this, we have the operational guts of the business, the systems. This is one of the most important and often overlooked parts of the triangle. A system is a repeatable process that allows the business to run smoothly and efficiently, ideally without your constant intervention. The classic example is the McDonald's franchise model. You can walk into a McDonald's anywhere in the world and get the same Big Mac because they have perfected their systems for cooking, cleaning, and serving. The goal of a true entrepreneur is to build a business that is a system, one that can eventually run itself and pay you. Next is legal. Many aspiring entrepreneurs ignore this until it's too late. The legal structure of your business is the armor that protects you and your assets. This includes things like choosing the right corporate structure, like an LLC or a corporation, to separate your personal assets from your business liabilities. It also includes protecting your intellectual property with trademarks, copyrights, and patents. Good legal advice isn't an expense. It's an investment in your company's survival. It's the strong fence you build around your valuable property. And finally, at the very bottom of the BI triangle, we find the product. This is often a shock to people. Isn't the product the most important thing? Not according to Kiyosaki. While you need a good product, it's the least important part of the entire structure. Why? Because a world-class business system can sell a mediocre product. But even the best product in the world will fail if the other parts of the triangle, the mission, team, leadership, cash flow, systems, and so on, are weak or non-existent. There are countless stories of brilliant inventors with revolutionary products who ended up broke because they didn't know how to build a business around them. So you understand the levels of investors and you have the blueprint for a business. But there's another layer to this. Are you mentally prepared for the journey? Kiyosaki spends a lot of time on the psychology of wealth. The number one emotion that holds people back is the fear of losing money. Everyone feels it. The difference is that poor and middle-class people let that fear dictate their decisions, leading them to play it safe and never take the calculated risks necessary for significant growth. A rich investor, however, learns to manage that fear. They understand that losing is part of the game. In fact, they see losses as learning opportunities. Think about it. Nobody learns to ride a bicycle without falling a few times. You don't quit biking forever. You get back up. That's from my voiceover. I want you to catch that live broadcast again soon. Figure out what you did wrong and try again. Investing is the same. The key is to play the game in a way where your losses are small and educational, while your potential wins are large. Don't bet the farm on your first try. Start small, learn the ropes, and build your confidence and competence over time. Another critical psychological trait is the ability to handle risk. Rich Dad's definition of risk is fascinating. He says risk is everywhere, even in what seems safest. Keeping your money in a bank is risky because of inflation. Relying on a single job for your income is incredibly risky because you could be fired or downsized tomorrow. For him, true financial security doesn't come from avoiding risk, but from learning how to control the variables. When you own a business or a rental property, you have a degree of control over the income, expenses, and management that you simply don't have with a stock or a mutual fund. The goal is to move from uncontrolled, high-risk situations to controlled, lower-risk situations that you manage yourself. This brings us to one of the most famous distinctions Kiyosaki makes: the difference between an asset and a liability. It's deceptively simple. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. The poor and middle class spend their lives acquiring liabilities that they think are assets. The most common example is their primary residence. Your house, he argues, is not an asset. It takes money out of your pocket every month for the mortgage, taxes, insurance, and maintenance. It doesn't generate income. An asset, on the other hand, is a rental property that generates positive cash flow after all expenses. It's a business that pays you a dividend. It's a stock that appreciates in value and pays you for owning it. The entire financial strategy of the rich is to use their income to acquire more and more cash-flowing assets. These assets then generate more income, which is used to buy even more assets. It becomes a powerful, self-perpetuating cycle of wealth creation. Your money starts having babies, and those babies grow up and have their own babies. So what kinds of assets should you be looking for? Kiyosaki primarily focuses on three categories. The first and most important is business. As we saw with the BI triangle, owning a business that you control is the ultimate path to wealth in his view. It offers the potential for unlimited income and gives you the most control over your financial destiny. Building a successful business is the hardest path, but also the most rewarding. The second category is real estate. This is a classic rich dad favorite. Kiyosaki loves real estate because it can provide both cash flow from rental income and capital appreciation as the property value increases over time. Furthermore, and this is a key point, real estate offers incredible tax advantages. The tax code is written to favor business owners and investors. Things like depreciation allow you to reduce your taxable income, even while your property is making you money. It's a powerful tool for building wealth that employees simply don't have access to. The third category is paper assets. This includes stocks, bonds, mutual funds, and other financial instruments. While many people see this as the primary form of investing, Kiyosaki views it as the domain of the B student, the technical investor. It's a perfectly valid way to build wealth, but he cautions that you have far less control. When you buy a share of a company, you're a minority owner with virtually no say in how the business is run. You are trusting the leadership and the system that someone else built. For this reason, he generally prefers to be the one building the company, not just buying shares in it. This might all sound overwhelming, especially if you're just starting out at level 0 or level 1. So what's the first practical step? It's not to go out and look for an investment. The first step is to get your own financial house in order. You need to create your own personal financial statement. Sit down and list all of your monthly income and all of your monthly expenses. Then, create a personal balance sheet. List everything you own that could be considered a true asset, something that generates income for you, and everything you have that is a liability, anything that costs you money, including all of your debts. Doing this exercise is often a sobering, eye-opening experience, but you cannot get to where you want to go if you don't know where you are starting from. This simple document becomes your report card. Your goal, month after month, is to increase the income from your asset column so that it eventually surpasses your monthly expenses. The moment your passive income from assets is greater than your living expenses, you are financially free. You no longer need a job to survive. That is the finish line. The second step is to set clear, specific financial goals. I want to be rich is not a goal. It's a daydream. A real goal is something like, within the next 18 months, I will acquire my first rental property that generates at least $200 in positive cash flow per month. Or, I will start a small online business and have it generating $500 in profit per month within 1 year. Specific, measurable goals give you a target to aim for and a way to track your progress. The third step, which is a lifelong process, is to invest in your financial education. Read voraciously. Listen to podcasts. Attend seminars and workshops, even if they're online. Find mentors, people who have already achieved what you want to achieve, and learn from them. Treat your financial education with the same seriousness you would a university degree, because the payoff is infinitely greater. Your knowledge is the engine that will drive your wealth creation. Finally, start small. You don't learn to swim by jumping into the deep end of the ocean during a storm. You start in the shallow end. Don't risk money you can't afford to lose. Maybe your first investment is buying $100 worth of a stock in a company you've researched thoroughly. Maybe it's starting a tiny side hustle that costs you very little to set up. These small ventures are your real-world classroom. You'll make mistakes, but the tuition will be cheap, and the lessons will be priceless. The journey outlined in Rich Dad's Guide to Investing is not a get-rich-quick scheme. It is a profound shift in how you see the world and your place in it. It's about evolving from being a piece on the board to being a player who understands the rules. More than just a guide to money, it's a guide to transforming yourself into the kind of person who is capable of building, managing, and growing real, sustainable wealth. It's a transition from being a consumer in the economy to being a creator.